Hello, hockey fans. Welcome to Toronto Maple Leaf. Oh no, that's not what we're here for tonight. Although it is St. Pat's Day. Happy St. Pat's Day to everyone. I got my shirt on. You'll see it later. Go Leafs, go! Wow, go market, go! It's when I contemplated what I was going to talk about this week, it was about how inflation was going to roil markets, and sure enough, no worries. Jerome Powell has our back. The Fed has all the tools they need to solve the inflation issue. I beg to differ. So we'll get into that a little bit tonight. I think it'll be an interesting session. Again, lots of time for questions tonight. A bunch of you emailed questions in already. We'll get to all of those, and then we'll have time for live questions. As always, follow me on YouTube. It's the repository for all our educational material going forward. And to all our partner companies and sponsors of our events, thank you all so much. And a special thank you to Bank of Montreal Exchange Traded Funds, who's been our partner in educating Canadians in this space for the better part of a decade. And for those of you who have made donations already, you'll all know, if you're regular visitors of our webinars, that we do them for free. They're educational focused. And all that we ask is that if you're getting value out of it, please, please, please make a donation to one of these two charities: cancer research at Sick Kids Hospital, or dementia and Alzheimer's research through the Baycrest Hospital. And we will match it. So you can double up. There's no better trade when you can double up, and it's for a great, great cause. So thank you to those who've donated, and a special thanks to BMO. Came through like a champ this year. BMO donated $20,000. So big round of applause to BMO. And it's just been a great partnership with them over the years. And tonight you've got one of their ETF specialists that is resident in Western Canada out of Vancouver, Renee Dinter. Renee's been in the ETF space with last several years with BMO, and prior to that with another ETF provider that shall remain unnamed. We don't have to go into that. But well versed in ETFs, and tonight he's going to talk about investing in banks using ETFs, and it's one of the simplest and most elegant ways to invest in exposure to interest-bearing assets. So Renee, welcome, and take it away.
Thank you, Larry, and it's great to be back with you presenting today and talking about investing in banks and using ETFs. As you know, ETF education is very important to us over at BMO. And so today we're going to talk about a few of our very popular strategies. Disclaimer here, as you know, not necessarily investment advice, but education, and hopefully we can provide some color around what is generally near and dear to Canadian investors' hearts, are those banks. And they've been in the news a lot. On the onset of COVID, they were in the news as, we started to lock down the economy, and all the banks were told to brace themselves and hold back capital in case we were to see loan losses and other instances where the banks could face some volatility in the economy and in the lending. And then fast forward to last year, where the banks were then given the okay to resume buybacks, increase dividends, put their capital back to use. And as such, they came back to the forefront in the eyes of investors. And so we're going to talk about investing in these banks. Let's start with the growth story when we look at the historical returns of investing in these Canadian banks, and here's a simple index that incorporates all the major banks in Canada versus the TSX Composite Index or the S&P 500, we see that going back into the late 80s and early 90s and total return showing up that on an annualized basis, a basket of bank stocks outperformed the TSX Composite by approximately 4% on average. So it's that white line at the top versus the composite in red and the S&P 500 in yellow, even outperforming the US. And so that despite some of the rotations we saw in other sectors in the Canadian market, like energy and materials, banks have continually shown to be relatively stable and provide a good source of growth and capital appreciation. When we widen that lens and we look at relative to global peers, we only have to look back and think back to, in the great financial crisis where Canadian banks were held up as the poster child of stability when a lot of other international financials found themselves in a bit of trouble, having overextended themselves in lending, subprime, and so on. So, banks have been a good source of growth for Canadians, so no surprise that they have been kind of generally loved as an investment vehicle. And when we get that, look at narrowing that lens and getting a kind of an update, again, as I mentioned before, they've outperformed the Canadian market by 4 to 5% on an annualized basis. And they continuously beat expectations on earnings. We see this it's almost expected now that when a bank reports quarterly earnings, it's how much are they going to beat expectations by? Not just meet those expectations that, Bay Street has kind of put forth and said, well, we think that they're going to make this kind of revenue. And it's both because they have good revenue generating abilities, but also often they can pivot to focus on efficiency in order to drive those quarterly earnings quarter after quarter and year after year. So they got a lot of levers that they can pull because they are well diversified and they're national. I mean, they operate in markets across the country, whether you're cheering for the Leafs in Toronto with Larry or heading over to the Canucks game with me here in Vancouver.
Boo, boo.
A former Torontonian, I can cheer for both, can't I? Also, we have analysts continue to predict bank stocks will do well. This is in part, as I mentioned earlier, because a lot of those loan loss provisions and the increased capitalization ratios that OSFI had them prepare amidst the onset of the pandemic have since been kind of pared back to normalized rates, which has freed up a lot of capital that's been stored at these banks to go out and generate more revenue, increased growth, and when I say growth, it's also through M&A. We saw a couple big announcements from two of the banks recently, TD and BMO, down in the US, and also increase their dividend payout as well as share buybacks. So a lot of this capital is now working its way into the share prices and or growing revenue at the bank. So there's a little update into this year. Now, when we look at we talked about the growth profile. When we narrow the lens on income, one thing that I learned is that the Canadian banks have been paying a dividend since the 1800s. So they've got a long track record of making these cash distributions out to their unit holders. And they've been very consistent in doing that, having not cut their distributions even amidst the financial crisis back in 2008, 2009. So we've seen resiliency, we've seen stability in dividend yield, and when you look at the chart, what you can see is the average being around 4%, except for periods of really heightened volatility like the financial crisis where yields spiked higher as a result of share prices coming down. But again, the amount of that coupon did not decrease, hence that percentage yield. And then coming back down as share prices stabilized. And then again, at the onset of the pandemic back in 2020, we saw a bump up towards that 7% range. But other than those two spikes during periods of volatility, a very consistent yield of around 4%. Today, when we talk about investment solutions from the world of ETFs, we're not just going to focus on Canada, we're going to focus on the US as well. But there's two things to note when we talk about US banks relative to Canadian ones. The first thing to consider is that US banks are more sensitive to yields and the yield curve. Because in general, the major difference is that US banks tend to be a bit more aggressive in their lending. They hold back less capital. And as a result, they borrow on the short end of the curve. So when we look at a yield curve, and here's a depiction of them in the graph, they're borrowing at these low rates and ideally lending for spread at higher rates down the road and longer terms. And so they're collecting that spread as revenue. And so a lot of their profitability is generated from lending, as I mentioned, because they are very aggressive. So when a yield curve steepens, it provides them, these US banks, with more revenue. And also this is why it's very important to see an upward sloping yield curve. And of course, you know, the yield curve isn't consistent. It's not a 45-degree angle. It has bumps, ups and downs. So there's various ways they can structure their loans. But generally speaking, the moral of the story here is they are a little bit more aggressive on lending, and the yield curve matters to all banks, but more so in the US. The other major difference is that Canadian banks are more national versus US, which are more regional. When you think of companies like Bank of America, a lot of their revenue is derived in the Midwest, or you think of a Wells Fargo, which is more Western based. So when we look at strategies to take advantage of the growth and income profile, here are two. Now, in this case, what we're highlighting is our covered call ETFs. Anyone who's been following Larry for a period of time is probably well versed in the mechanics. So I'll simply highlight the two and the consistency of these strategies. So first off, when we look at the Canadian covered call banks, that's the ZWB, we have a good distribution yield of over 5%. So that's dividend yield, which in the chart on the left is highlighted by the dark, call it purple or reddish shading. So a dividend yield of approximately 3% on the overall portfolio if we look at this chart as of today. And in addition to that, through a covered call writing, we're generating an additional call premium of approximately 3%. And that's that light red shade. So we often use this slide on a lot of the material available at bmoetfs.ca when we talk about how much yield we're creating. And we show you that you can generate that nice stable dividend yield, plus get that premium from option writing. Essentially writing on 50% of the stock we own. So if we own $100 worth of bank stocks, we write calls on 50% of it, or $50, out of the money 1 to 2 months to expiry, and forego some of the growth, not all, but some, to generate that option premium. And again, it's been very stable, much like the underlying dividend yield. The option premium we seek to generate is very stable, and even the degree to which we are out of the money has been very stable, unless we see periods of volatility like that little spike up between in November 21 and January 22. On the right side, we have our US covered call banks, same sort of idea, just different ratio, different amounts. The difference I'll note, and this is all I'll note on this slide, is a smaller dividend yield, but because of the benefit of that extra little bit of volatility in US bank stocks, more option premium. And the nice thing to note on all covered call strategies is when you own the stock and you write calls on those stock, the income or option premium we're generating is taxable as a capital gain to a Canadian investor. Now let's say you wanted to balance that out. I got my equity exposure and I wanted to add a little bit of fixed income type exposure, and I have essentially a balanced allocation but stick to the banks. BMO recently launched the ZBI, the Canadian Bank Income ETF. ZBI simply looks at all of the non-equity securities of a bank. And so, for example, I'll speak to BMO, I work at BMO, we would include preferred shares, traditional fixed income or bonds, as well as access to what are somewhat newer fixed income or bond-like securities in LRCNs, which are limited resource capital notes. Essentially what we would consider kind of a hybrid to a traditional bond. And so within this portfolio, you get 60% traditional bonds of various maturities issued by a bank, and 40% of hybrids, which would be preferred shares and LRCN or limited resource capital notes. They often give you nicer yields, and overall you would get a nice heightened yield versus just looking at the Canadian bond universe. So here you can generate a much nicer yields in what is traditionally a safer asset class, and I'm sure Larry's going to go into more specifics on bonds as he talks about inflation and rising yields. So I'll leave it at that. This is just a snapshot. As I mentioned, all the benefits, but you can see here all the types of different securities that are being included in ZBI. Preferred shares, institutional preferreds, LRCNs, debt, senior debt, all of that. We're looking for opportunities in that on the bond side and not the common equity side. So again, a nice complement to a covered call or even a bank ETF.
So Renee, normally I take the Q&A at the end, but someone actually wrote in a question this week asking very specifically, not knowing you were going to talk about this, about some of the intricacies of how ZWB and ZEB kind of work. And they're asking some questions about double dipping on the management fees and why one ETF actually owns the other ETFs. Can you talk a little bit about that?
Absolutely. Thanks, Larry. So this is a great question. So thank you to whomever sent this in because it highlights a number of things. First off, when it comes to building a investment fund or an ETF, in this case, when we look at the holdings of our ZWB, as I mentioned before, the covered call Canadian Bank ETF, you'll notice that there's a 25% weighting in ZEB, which is the BMO equal weight bank ETF that is not a covered call, it just owns the banks in equal proportion. And so it seems on the surface you would think it's redundant. Why would you have that? Well, as a manager of this ETF, we like to have this because it's very efficient. The ZEB, the Equal Weight Bank ETF, in and of itself is very efficient at getting us the exposure to the same banks of which we own the individual securities. And so we have that same exposure, but because it's in one single ticker with great liquidity, we can use that to rebalance our portfolio. Instead of holding cash, we can put any excess cash in there, so the portfolio is always fully invested in the underlying securities. Or if we need to make room for a redemption, or someone selling the ETF, we can sell a little bit of this using a single trade. And so so holding an ETF in an ETF is often done simply as a way of having a very efficient, low-cost rebalancing tool within the portfolio, which effectively has the same exposure to the actual strategy. And so that's why we wouldn't just hold more shares. Now, keep in mind, when I mentioned earlier, we write on 50% of the portfolio. And so we do own within the portfolio, 75% is owning those individual securities and 25% in ZEB. So we're not writing on the ETF. We're writing on shares that we own, and also because it gives us that nice tax treatment.
Right.
And then the last thing to note
is, yeah, the double dipping on fees. So you don't do that, right?
That's correct. And we don't double dip. So we rebate the fee of the ETF inside the ETF.
Right. Very good. So hopefully that answers the question. And finally, our great educational partners, tomorrow we'll be talking about income investing. And I imagine all these ETFs might be featured, and you'll have some of the portfolio managers who help run these strategies talking.
Absolutely. Please subscribe. So thank you very much, Larry, for having me on today.
Thanks again, Renee. Looking forward to seeing you one of these days on a trip out to Vancouver.
Same.
All right, so go Leafs, go. Okay, we got that out of the way. Now we can get to business here. Okay. Whoops. Don't hit that button. I'll end the webinar. Okay, so I'm going to give you a little bit of update in the geopolitical front and some of the things we're seeing and observing there. I'm going to talk a little bit about the Pro Eyes indicators. When I was preparing this early in the week, it made a lot of sense on Monday to talk about, because we had the most attractive readings we've had in a very, very long time in our Pro Eyes series, suggesting there was a lot of opportunity for a rally. And here we are Thursday, and I would guess 70 or 80% minimum of that rally potential has already happened. So, but nevertheless, we'll have a look at that. And as my topic of the week that we covered on Berman's call, why the 1970 asset markets actually matter. And we'll take a little bit of a deep dive there on inflation. And I've got some great charts from my friend David Rosenberg through some of his research this week. So let's take a dive in terms of geopolitics. I have a chart here of KWEB, and I know there's a question that has come in on this ETF. So, when I look at from an investment standpoint, I'll talk about the geopolitics in a minute. I look at trend. So I've highlighted this trend channel going back a number of years, and so when we come up out of a trend channel, so this can happen for individual stocks and whatever, but when a whole market, a whole industry, does this, it starts to get very speculative. And when that happens, I just say, hey, it's overvalued. You just got to wait for a correction. And so, early 2021 on one of the Berman's Call episode, I suggested that KWEB was a hard sell. At the same time, I talked about Cathie Wood's ARC ETFs as a hard sell, speculative. Again, I took a lot of criticism for this because people like to buy what's up and going higher. It's just a natural human condition. But I'm a value guy, right? I've said that for years over and over. And so I started to get interested, back in the $50 range and started to accumulate KWEB months ago. Now, there was a bill that was passed in 2020 by Congress. It was it was part of Trump's trying to crack down on China, but really, Lukin, which was a fraud that was uncovered by one of these short seller funds, and everybody may remember the story, was one of the catalysts for this, and saying, hey, Chinese companies, you don't open your books to our regulators and kind of show us what's under the hood. And so you had this fraud, and because we're mad at you and you steal intellectual property, we're going to come up with this Holding Foreign Companies Accountable Act, HFCCAA. And effectively, Congress restamped this recently. And earlier this week, China and a major regulator in China opined and basically said, don't worry, we're on it. We'll come up with an agreement on this. So as that trend broke late last year, it was really that Xi was saying, common prosperity. They had gone to those online educational firms and basically nationalized them, and there was just narrative that China's just going to screw everything up. And I don't expect that, and I don't think that's going to happen. And I think China, for all their common prosperity goals, understand that the capital markets are why they've grown like they have over the last 30 years, and specifically since being allowed into the WTO, World Trade Organization. So I think we're going to recover here on KWEB. It's going to come back into that 40 to 50 range, but there's an awful lot of overhead supply and people wanting to get their money back that may have listened to me, maybe not. But how I traded this is I maintained my position. So whatever my allocation was to this ETF, as it went down, I maintained my position. I wasn't doubling down. I was maintaining my allocation. So when it ripped the other day, I ripped from the same value in terms of the size of its influence on the portfolio. So, I think we're okay here. And what we've heard, and what we heard late today in the business day, is that China has called out Russia for atrocities and war crimes. And listen, the Chinese are very, very specific in the words they use when they make public statements, unlike US politicians and Canadian politicians that just kind of, say what's on the tip of their tongue, kind of like the previous president of the United States did. So they're very calculating, and they say it with meaning. So you kind of got to believe them when they say things. Now, interestingly enough, I think it was JP Morgan that literally hours before the bottom this week in KWEB came out, downgraded all the major stocks, BABA, all of them, and said China was uninvestable, literally right at the low. And so, you got to look at something like this. And if you're investing or trading, you got to think about it, differently. And, I like the exposure. Chinese internet stocks are amongst the cheapest internet stocks on the planet. The question is, are they going to be there? Or are they going to be regulated? Are they going to be sequestered? Are they going to be nationalized? Those are all real risks, and why they don't trade at the valuations that we see elsewhere in the world. But when we're in a market environment of rising rates and rising inflation, stocks with high PEs underperform always. It is just the way it is. And there are a lot of things in investing that just happen because of the environment we're in. And so again, that's kind of my KWeb story here. And my average cost on this is in the low 40s. So it is what it is. But I still like the exposure. There's some great companies here. I recently bought the Korean version of Alibaba called Coupang. Average cost around where it is today. Again, bought it, maintained my position as it weakened. I bought it initially below the IPO price where it came out last year. I thought it was very attractive. Anyways, you can never time these things perfectly. You don't know where the bottoms are going to be for sure, but with almost certainty, we've made a bottom here. This bottom, you're probably never going to see this level again. So I know that's a bold statement, but it's kind of what I think. So that leads us into what's happening in Russia and Ukraine. And 48 hours ago, they were making a lot of progress. You come in this morning, you wake up, and all of a sudden the Kremlin's saying, yeah, no, not so much. And, markets sell off a little bit, but then they get buoyed by another statement. And so, you're in that high noise factor market right now. And I think unless the war escalates up a notch or really lasts for months and months and months, we've probably seen the bottom for equities for now. Okay. And why I say for now is because we don't know 2 quarters from now what impact the Fed tightening cycle is. And that's really the talk tonight as I get into it on what that Fed tightening cycle means. Because if you look at one version of history, you see the inflationary environment or the tightening Fed environment, at least for the next year, is actually pretty bullish for stocks. And so that narrative made the rounds this week and maybe, buoyed some people. But at the end of the day, Putin's a war criminal. There's no doubt about it. The US and NATO wants to give him an off-ramp here, sadly, but truly, where he can save face with his people so that he has a motivation to do it, claim some sort of victory, and hopefully a couple years from now, the Russian economy recovers. But make no mistake, talking about not being investable, I don't know when we're going to be able to actually trade in Russia again. I don't know many people who will want to, but because of all those factors, there's going to be some really cheap assets. Now, here's another case in point where you have a country that can, with an autocratic government, can nationalize whatever they want, right? So that's always the risk with China and a centralized government. That risk now is more than magnified under Putin, and it does make Russia uninvestable for a long time. So it'll be interesting. But they did pay their bond. They are not in technical default, and that was a big thing, kind of ripping markets too this week, where they got some relief. So when we look through the Pro-Eyes series of indicators, remember 3 metrics we're looking at: valuation, business cycle factors, which is credit, leverage, debt, and so forth. And then our technical tactical factors, which has to do with breadth and sentiment and how volatility is trading and cycles and all the technical things that you would expect one to look at. And you can see by looking at these that the tactical factor at 19% is as oversold as it was at the depths of the market after COVID. Now, that COVID shock was a couple of weeks and boom, 35%. This one isn't nearly that long, right? So that has to bear in mind. The business cycle factor is moderate. We still have the weekly indicators pointing to a pretty robust, underlying economic trend. So when Powell says the economy's strong this week, they're looking at some of these things. I beg to differ on that. I don't think the economy's that strong. But we're now seeing the yield curve, and there's been a couple questions to come in on the yield curve. Renee in his presentation tonight talked about the bank funding markets. They borrow short, they lend long, kind of looked at the yield curve there. And that's, so banks fund themselves by issuing debt, preferreds, all kinds of ways they can raise capital. And they can fund the loans through commercial paper, through the CDOR market, and the like. So money market type funding. They do have some bond type funding too, but the vast majority of funding is floating rate, short-term stuff. And they tend to lend for term. Now, mortgages, they'll lend floating, but everything for the banks is about a spread and not taking risk. The vast majority of income and earnings from the bank is in the bank, meaning it's virtually guaranteed fees and spread. And they manage the spread and fees. Now, when they own a broker and there's assets there, they can't control the value of the markets going up and down. And that capital market side is a big variable. But the vast majority of income for banks are very fee-based. So the slope of the yield curve is directly proportional to the profitability of banks. And the profitability of banks is directly correlated with them providing credit for the marketplace. And the economy expands and contracts based on money getting spent, GDP, which is everything we all earn plus credit. So what happens in the credit markets is very important. But when inflation is rising at a faster rate than funding, you have these negative real yields. And I expect the liquidity and the real yields to be very, very positive underlying. But now we're beginning the cycle of unwinding that liquidity that's been supporting markets. And in that environment, it's not they're bullish. And ultimately, and every time in history, with very few exceptions, when the Fed is tightening, the yield curve will invert. It's not inverted yet, 2s to 10s. It's not inverted money market to 10s by any stretch of the imagination. And it's really that funding market to the lending market inversion that really tells us we're at the end of the business cycle or the credit expansion. So until that happens, and historically once that happens, you're still 12 to 24 months away from the official recession. And that's what the narrative was this week. And say, don't worry about the Fed starting to raise rates, because historically, when they do on average, the markets are still good for another year. So what is inflation and is it transitory? So my good friend David Rosenberg gladly allowed me to clip some of his research this week. And we went back, or he went back and looked at all the other cycles where the spike in oil prices was the key catalyst for goosing inflationary pressures. And he went back until the early 80s. And the problem with all this analysis is it doesn't go back into the 70s, and which I'm going to do in a little bit here. But yes, in the rate environment where Volcker raised rates, crushed the back of inflation, that every spike we've had that has been led by energy markets, once energy markets correct and normalize, inflation comes back down. And that's what all these graphics are showing over all the other cycles. So when the Fed says it's transitory, it's largely off of the energy story being a big component. But there are a lot of things this time that are different, that aren't transitory. So when we go back into the 60s and we look at all the recessions and we look at the CPI for food and energy, we can see that the recessions are almost always linked to these spikes and because it's the Fed taking the punch bowl away. In all those other past cycles, with the exception of the 1970s, it was generally some sort of demand pull, not always, but generally some sort of demand pull, end of the business cycle, where the Fed tightening did kill the demand. But we're now in an environment where the government's printed trillions of dollars around the world, got everybody back to work. Thankfully, we've got vaccines and we're able to normalize. And I don't want to get into a debate about the efficacy of vaccines or not. Whole other story. But these are all supply chain issues and labor market challenges that raising interest rates are not going to fix. Making money more expensive will cause a recession here. And so what's priced into the market now by way of the Fed, I would offer up, is not going to happen. They're not going to be able to fight it. So to the extent that these supply issues, whether it's the rebalancing of Russia's supply of oil not going to the West, but going to Asia, China and India specifically, who need it and will buy it at a discount, and they don't really care about the geopolitics of the West and NATO. They do, but they don't. And so that takes a while. But the whole ESG story and the underinvestment, these companies, these oil companies, when they're talking to us now, they're not boosting CapEx like they did before to increase the supply of oil. So the big question to me is here, have we hit peak demand yet? And is this whole move to a low carbon future in full gear or not? Because that's going to tell us how long this oil price surge, which is impacting a lot of prices, but not everything. So it's oil for sure, and that will normalize, but this time will take longer than others because of those ESG reasons. How much is everything else, the labor supply, the onshoring, the less globalization? For the last 40 years, globalization has caused this deflationary wave. And as we determine, you heard out of France today, perhaps, they may need to nationalize some of their oil companies under the guise of domestic protection so that they don't have to rely on foreign sources for energy. Like the world is getting smaller from that perspective, and that's inflationary compared to globalization. Again, we can debate this topic for a long time here, and there's rights and wrongs, and I welcome the debate and discussion, and it's very interesting. I don't think anybody knows. I think we're in an era where it's not similar to a lot that we've seen before. And so, when we look at some of the past shocks and we look at the Fed rate hike cycles, so this was from a Bloomberg article that I featured on the show on Monday that came out over the weekend. LPL Financial is a RIA platform down in the States, and they got a bunch of data here and they looked at all the rate hike cycles, and they basically said, markets are pretty much up most of the time, 3 months, 6 months, 12 months later. Don't worry. They didn't look at the 70s in here. Maybe they did that on purpose because that didn't support their narrative or their story, or maybe they're, I don't know. However, when we look at the 70s and we look at the Fed policy, so the white line here is Fed's moving their interest rate up and down. So the rate hike cycle that started, you could argue here, but maybe that was an ease because of this. This was Nixon, so you had, but this was the oil shock, right? The oil shock was 73, 74. And that was the inflation shock and the beginning of the tightening cycle. And both interest rates and equities performed very, very poorly in that area, in that era where it wasn't just temporary. The shoot up in inflation pressures actually lasted quite a while. Now, at some point, you get that bounce, and we bounced. We bounced pretty significantly. And as always, they start cutting rates to help out, and eventually it works and the markets recover. And then inflation started to tick up again. And so what happened? They started to raise rates, and they started to raise rates, and they started to raise rates. And all of a sudden, this wasn't this one, but for 3 years, no gain in equities as inflation and interest rates were rising. So rising inflation and stubborn inflation and sticky inflation is bad for both stocks and bonds. Now, this isn't the 1970s. We're not going to go into double-digit inflation. And when I say not, I'm doing a little bit of this. But the mathematics of it suggest the year-on-year rate of changes that inflation will peak this month or next. We'll see. I hope so. That's the expectation. But if it isn't, and the Fed has to get more aggressive, you can bet that capital markets, bonds and stocks, are not going to like that. And the yield curve will invert, and that will mean a recession coming down the road. And again, at that point, earnings start to contract. So let's have a look then at what Rosie put together this week in the various different asset classes. And I apologize for the clarity here, but it's a cut and paste of a cut and paste. So it's a little bit fuzzy on the data because I blew it up and it wasn't a high resolution. But look at the percentage change overall in the markets and the different sectors and how they performed when we had inflation and rising rates impacting capital markets. And so obviously the energy sector did the least worst, but still was in a decline, even though energy prices were going up. Why? Because inflation was rising at a high rate where the real return was actually quite poor. And so there are places to hide, the more defensive sectors, healthcare, consumer staples, materials, high inflation, energy. Those actually made some sense. You can also see that telecom, right? So what's now called communication services. So the more defensive sectors did better, but still were down. So if this scenario plays out and inflation's stickier, I don't think asset prices do well at all. Volatility on average, percentage-wise, elevates. Bond yields, higher. Credit spreads, higher. Investment grade spreads, higher. CRB index, lower. Gold, up. US dollar, flat. So that's kind of what happened in the 70s. And so the question is, what do we invest in? If everything's going down, Larry, are you telling me I should just buy gold and buy VIX? No, not at all. But it's going to be a challenging couple of years here. And so I thought through, okay, well, what would get us through And BMO has a great ETF that I've talked about for years and used for years. It's not risk-free. It goes up and down. It's interest rate sensitive. It's got utilities by way of pipelines in it, so it's sensitive to energy. So you can see in 2015, 2016, when oil prices collapsed, the ETF didn't do well. You can see that if you were to overlay a chart of rising interest rates, that through periods where interest rates were on the uptick, it didn't do particularly well because of the utilities kind of act a little bit like a bond sometimes. They're regulated, their cost of capital goes up and so forth as interest rates rise because they're very, very debt intensive, utilities are. But when you look at ZWU and what's in it, which we'll do in a second, you know, there's a pretty compelling story, but it does have its risks. It's not risk-free. COVID happened, it fell considerably, considerably. It's just recovering now, but a covered call strategy that gives you an extra enhanced yield over a year doesn't protect you all that well if the correction happens in a couple of weeks. If the correction happens over a longer period of time, you benefit. But again, this is an ETF that, you know, is yielding 7% right now. It's giving you exposure to a lot of great utilities, some new infrastructure plays. It's got an average dividend yield. So the underlying, like Renee was talking about with the banks, the underlying yield, 4.35%. And then you got the covered call overlay that adds another 2-3%, as Renee was showing with the banks. It's got okay valuation, but it's not cheap. And it's not cheap because a lot of money is playing for the safety and the yield these days. And so a lot of these companies have higher valuations. Many of the pipelines in here have yet to get the benefit of the recovery of the rising oil prices. So their PEs are not great here. So that if you normalize that PE number, it would be a little bit better than the 27.72 trailing PE. But generally, something like this for the next few years is probably a decent holding. Don't run out and buy it tomorrow. Don't make this 50% of your portfolio. But for the coupon clippers out there that want lower volatility, this is something to hold. Having said that, I recently just sold it out of my ZZZD fund. And you might ask me why, and it's because a lot of the gains that is part of the safety of this ETF is already in the price. And I didn't like the pipeline exposure at this point because I think we've hit the top in the oil markets. Maybe a good call, maybe not. We'll see in 6 or 12 months. But if this thing drops back below 1250, I'm going to add it back to the portfolio. Okay, let's get into some of the Q&A questions that have come in. With the talk of recession, would now be a good time to add healthcare, utilities, and consumer staples? So great first question. We kind of talked about that, and you saw that in bad markets, the cyclicals, the higher PE names, the riskier sectors underperform. Last week, we talked about the concept of relative strength. So is healthcare cheap? Are utilities cheap? Are consumer staples cheap? No. But will they do better on a relative basis for the next few years in choppy markets? And I would argue yes. So within healthcare, large pharma, big dividend payers, utilities, big dividend payers, some of the consumer stocks, good dividend payers. You can hide out in those, clip your coupons. You've got less market volatility risk, or not, or sit in cash and let inflation, you know, ruin that. So, you know, you decide what you want to do, but you know, good question. And for defense, sure, but they're not cheap. They're within these names, sectors themselves, there are some some good valuations. So I said this week on BNN to Andy, one of my biggest holdings right now in my stock fund is NIO. And when you put it up against Tesla, I think NIO is going to be able to compete with Tesla on a global basis, in the West as well as the East. And frankly, there's more of a market in that part of the world at the price point that NIO delivers it compared to Tesla. Anyways, we can debate it, but Tesla's trading at 70 times earnings. NIO does not have any positive earnings yet, but will start turning positive next year. But when you value the company on an enterprise value to EBITDA basis, it's the cheapest way to play it globally. You have to be somewhat confident, what I was talking about before regarding China and how they deal with their companies. But make no mistake, this is a badge of honor for China. They have a little bit different view around the data-centric companies where they're using your data because China likes to control the message. And so the Facebook equivalents, the Tencents, those are going to be under far more scrutiny for sure compared to NIO, but my biggest investment right now. So I like it long term. Could copper stocks continue to do well if we get stagflation? So I think copper stocks do well on average in general because it takes somewhere between 7 to 10 years to get a mine fully operational. The demand for copper in the electrification of the world, which is the future, is way ahead of the curve in terms of the potential supply coming on stream from what I read from the analysts. But if we go into a bad economic environment where we have stagnating growth and high inflation, precious metals are a better hedge than base metals because of the economy weakening. The demand side is going to mean not that we're not going to use copper, but we're going to buy fewer cars and we're going to have less demand. So there'll be less use of copper from that perspective. And if you're worried about inflation and negative real yields, precious metals look better in that environment. And right now, copper's got a long runway here. I've got some good copper names and I'm still overweight the sector. Would an ETF like VEQT be appropriate for a young new investor with decades of time on their side to gain diversity and all-in-one starting investment in either RSP, ETF, SA? Would I recommend the same ETF for a taxable account? So let's bring up our Bloomberg here, and I'm just trying to find where, oh, Bloomberg here. All right, so let's see what the world is doing here. Futures are off about 0.5% right now. Okay, so let me VEQT. Have a look. All equity portfolio Canada. So let's see what's in it if we can. So here's an ETF that has a wrapper of other ETFs. So, you know, good one ticket solution. It's got the all US market exposure. Looks to be about 42% of the portfolio. Canada's 30%. Developed all world, so EFI, and then emerging markets. So right now, I don't like the asset mix here. I think international markets are far cheaper, and I actually traded out my Canadian exposure in some of my ETF funds, and I added to emerging markets and international in this last term down because Canada's been doing relatively well because of energy, and I wanted to underweight that energy and overweight the international markets that were off 20 or 25%, at near their recent lows, which to me is much more compelling value. So when you buy a one-ticket solution like this, it's fine. There are no issues with it at all, but you lose the flexibility of moving around your asset allocation. What I don't like about these is that they overweight Canada. Canada's 3% of the world. Canada is great with the banks, and we have some commodities, so that's all good. But we don't have healthcare, we don't have technology to speak of, and that is a big part of the future, and we don't have a lot of consumer. We have three very important sectors for the next 10, 20, 30 years that Canada doesn't have in the index. So when you're overweighting Canada, you're overweighting the banks and you're overweighting energy companies. And I'm not sure you want to overweight energy companies. Maybe for the next year or so, but beyond that, it's an underperform. So great question. It is a good way to get started for sure. Can I please ask, okay, Web. So I have a 2/3 position acquired, blah, 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 blah. People said it's uninvestable. Listen, I don't think China's uninvestable. China needs the world more than the world needs China. If China can't grow their economy at 5-6%, they're screwed. There's no other way of looking at it. They've got all the problems of an aging population and high debt and everything else, except for the fact that they can control the narrative. And so China needs the world to grow. They need to export. They're building their retail, their sales, their consumption, but it's not anywhere close to where the developed world is. When China has their GDP per capita that is only, say, 20% below developed markets, at that point, maybe different story. Maybe they close the economy more. They don't need the exports as much. But they have this Silk and Road initiative. They want to be the reserve currency. They need global capital markets, period, stop. It's not investable because of the uncertainty. It's tradable. You have to think about it in those terms, I think. But that's some of my color, and I have exposure there, and I like China. At the beginning of the pandemic, I purchased VCNS as a very safe option. Okay, so let's now have a look at VCNS and what's in it. Let me see if I can't blow up the font here so people can see it a little bit better. Oh, how about that, eh? 300 times resolution. Okay, so that's a little better. So looking at VCNS, you've got the Canadian bond market, 30%, sorry, 35%. You've got US total market at 17. You've got, so you've got all these holdings in it, but the bond component is 60% of the portfolio, okay? So let's just do some comparisons here of performance, and we do it on a year-to-date basis, and we look at VCNS, and then we say, well, what did VAB do? And that's the Canadian bond market. And what did VTI do? And that's the US equity market. And we kind of just do something quickly like that. And you can see why this conservative portfolio is down, because both bonds and stocks are down. So nothing is actually up. And then the international markets exposure in here is even worse. So for your conservative, it doesn't mean you're not going to lose money. But bonds, traditional bonds, are going to be a really, really bad investment for years to come. I've talked about this extensively. So good question. Should you continue to hold it? Now, here's the point where it's hard for me to give advice, because I don't know you. I don't know how old you are. I don't know how much money you have. When making financial recommendations and you're a fiduciary and you have an obligation to give open and honest advice. You have KYP, know your product, KYC, know your client. I don't know who you are. And so I can't recommend anything specifically for you. Is this a good product? Is this a good ETF? Is it a low cost? Does it do what it says? All the boxes checked. Follow? Okay. Great. Okay. Let's go back to the board. I'm in the midst of reviewing my portfolio for the purpose of determining diversification. I have a wide range of diversity, North American, Europe, emerging markets. I have a tendency to pick sectors using ETFs or individual stocks. What would I recommend for diversification purposes, looking at current times? Okay, so last time around, 2 times around, I talked about different investment themes, right? I talked about uranium, and I talked about Chinese internet stocks and fintech and Kathy Wood stuff and all the thematic clean energy. So we went through all of those. And so I have in my universe of my portfolios that represent 20 to 40%, depending on the mandate. I will trade in and out, up and down. So uranium right now, 3%. It was 4%. I just trimmed it. If it sells off more, I'll add it back. If it goes higher, I'll trim it again. And then that money rotates into something else where there's better relative value. So that's how I do it. I like it. I think it works. And I would recommend that you try to look into that kind of thing. Figure out what you want to hold, what you want to invest in, what you want to trade in, and figure out how that ultimately works into your time frame. Is this the bottom? Is this the bottom? No, I'm pretty sure the next 2 years are going to be very difficult for capital markets, given the Fed tightening cycle, given all kinds of issues with stagflation. The markets aren't going to rip higher here. I would be an absolute shock if that happened, given the underlying set of circumstances we're in and the fact that governments won't spend money and the central banks are now doing QT. ZWC, Canadian High Dividend Covered Call ETF, was purchased for exposure, Canadian dividends. Okay, so I should have probably given this question to Renee too. But basically, Kevin last week, Prince, talked about good rock and bad rock. So this return of capital is not that ZWC is not earning enough. The dividend pass-through is there, the yield is there. The rock has to do with the size of the ETF and the growth and then managing the number of units and so forth. And so that's actually a good return of capital. It's not setting up investors for paying high. This is not a strategy around tax. That's not how it works. And your conclusions here, I think, are off. And I would ask that you email me again very specifically about your issue with this. I will put it in the hands of the experts at BMO to give you the answers and to make sure your orientation and beliefs are what's happening here are actually happening, okay? Because I'm not the expert in this tax part of this, okay? So that's really key there. So with that, we've got another 20 minutes left. The Leafs just scored again, so hooray for us. Let me go to the question board here. And so Louis or Louis, again, I don't know how to pronounce it. Guys like it, use it differently. Says, happy St. Pat's Day. Thank you, Mitch Marner. My comment on the 2s10s curve. So I've commented on the inversion, on the profitability of banks, borrowing short, lending long. It all has to do with the expansion and contraction of credit, which is the biggest single swing factor in terms of economic expansions and contractions. When credit contracts, the economy inevitably shrinks because there's less GDP. And so I do believe the Fed's biggest risk here is a policy mistake, because them raising rates is not going to fix what's causing inflation here and will hurt economic growth. And those that tell you different than that, I want to have that debate with them, because I have a very different view. It's not fist pounding, Larry's right here, don't listen to anyone else. That's not what the view is. I think it's a common sense understanding of what drives the business cycle, and not that anybody else who has a different view doesn't understand the business cycle. But I welcome the debate. And so I think the Fed does make a policy mistake here. And so if they don't, what that means is they can't raise rates anywhere near what their dot plot had suggested. And so there's a narrative that's just starting to build where they're using the dot plot as forward guidance to say, here's what we're going to do if you let us, capital markets, but if you don't, so in other words, the Fed put will come back as long as inflation pressures moderate and equity markets sell off. But if equity markets are stable, they're going to continue to raise rates until they break the damn thing. I don't see any other way. I don't. So again, good question. Larry, what's my view on the huge inflation increase in short term, and will it not have a major impact on markets? So I think I covered that pretty well. What's the state of affairs in the world is wrong with heavily weighted on dividend ETFs like ZWB dividends and ZPay. With the state of affairs in the world, would it be wrong to be too heavily weighted on dividend ETFs? So no. So again, you're not without capital markets risk. You have it. You're just lowering the sensitivity of risk. Now, what we saw with COVID, it was a black swan. The world shut down immediately, and the extra income you earn from the covered call strategy is earned over a long period. And so if the sell-off happens very quickly, you get no benefit from it. So that's, I think, what you need to understand, Randall, about those names. And I talked about ZWU a little bit tonight as well. I'm wondering what the ticker on NEO is. It's NEO. I don't know why you couldn't find it, but it trades in, Lisa, it trades in New York. It's an ADR. I own it. I trade it. Trades in New York. Do you think we will escalate to a world war, and do you think gold is the place to sit to wait it out? So, Dave, I don't. Putin has rumored to talk about the nuclear option. What mutually assured destruction is all about is both sides knowing that they can't ever pull the trigger. It's all those movies that they all said about war games. The world's going to end if you do this. So that's not going to happen unless the key is put into the hands of someone who doesn't need 5 other people to turn their key at the same time. Now, what we saw in Russia was nobody believed that Putin was going to do what he did. Like, everybody got it wrong. Now, the US warned that he was going to do something, but the thought was that he would saw off the eastern part of Ukraine, not go for Kyiv. The fact that he surrounded it and had troops in Belarus and close to Kyiv, and to me, said something very different. But I don't think anybody knows, and unless Putin actually attacks Poland, which their army now can't even do the job in Ukraine, spreading it thinner and fighting a greater enemy with superior air support than what Ukraine has today is suicide. So does he threaten nukes? No, because that it just won't happen. So we're not going to World War III in the conventional sense. But make no mistake about it, we are in World War III. And what I mean by that is the political divide, the fracturing of capitalism, the rise of statism, the deglobalization. I think social media might be destroying a generation of people. I love the open debate and discussion, but the amount of hate and intolerance and disrespect and everything that was probably under the surface. And you notice the people who are, they never show their face. They're a meme. So are they bots? Are they real people? Anyways, I have lots of strong views on the decay of the West. The jihad that started, decades ago. You could argue 5,000 years ago, but decades ago, and 9/11, and the goal was to destroy the Western way of. And there was always this church and state. Whatever your church is, there was always this church and state, issue. And mine is better than yours. And I think we're seeing a lot of downside in the world. But that doesn't mean you just buy gold, right? It's not the answer. And the gold bugs will tell you that, but that's not the answer. Larry, can I offer an explanation why companies beat estimates close to 100% of the time? Great question. It's a game. CEO, CFO, the officers, they look at the budget, they know the sales trends, they know approximately what they're going to earn. So they give guidance to the streets, they go to conferences, they tell analysts, well, we know we're going to probably do this. So they underpromise and they overdeliver. And the shares get a boost. And guess what? They get compensated with stock options. And so it's a big game. Everybody knows it. The street plays it. It's not because the economy is doing better. So whatever the consensus earning is the whisper number is a discount to that. And sometimes it's even better. So does that mean that they're even playing more financial engineering and doing all these kinds of things? So there's probably a bit of that left for sure. But good question. What's the difference between ZWB and ZEB? So hopefully Renee answered that, but one is covered calls and one is just a plain equal weight bank exposure. So one has a higher yield to it, but you give up some upside in a strong up market. ZWH is taxed as straight income, but if you mention ETF of American banks that trades as capital gains, please explain. So this is a good question. ZW isn't straight income. The dividend, which is a big part of dividends from foreign corporations, CRA is not going to give you a dividend tax credit for a US company because that US company didn't pay the Canadian government any tax. But the Canadian corporation already paid tax on their income, so they don't want to double tax the dividend, and that's why you get the benefit of the dividend tax credit when it comes from a Canadian company. But just because the ETF trades and sits in Canada, it's still, that dividend is coming from a foreign corporation, which CRA defines as income. The covered calls are treated as capital gains. And that's what Renee was referring to when he talked about the banks. So the dividend off the banks is income, but the capital gains that come off the option covered call writing is on account of capital. Good question. All this EV cars are going to cause for electric supply. If we get 20% more EV cars, where will the electricity come from? There's already short supply. Thanks. So Gene, good question. And they're going to have to create it. And so right now, that energy comes from burning carbon in fuel. So the idea would be to, you could burn oil to store as energy, to increase energy, but you wouldn't want to do that. It doesn't solve your climate problems. So you want your development of new energy to be green: solar, wind, hydro, hydrogen, and on and on and on. Algae. Chevron, the oil company, just bought the largest producer of algae-based whatever this week, last week. So they want to be the energy company of the future. They're going to have to go to green energy. We're still burning carbon for 30, 40, 50 more years, no doubt about it. The mix is going to keep changing towards green, towards green. The purists want it done today, and that's just idiotic. I get the reason why, because the planet needs it, but it's not going to happen. It was never going to happen. It should have happened 30, 40 years ago when people were starting to raise concerns about it. But a company like Chevron back then bought the EV company. If you saw this movie they made, or the documentary they made about it, bought this company. I can't remember what it was called, and they just buried it. So the EVs didn't get a start 30 years ago, something like that. So that was the oil company thinking now. Today, if you're not an ESG leader, your cost of capital goes up. If you're the oil company today, you know that maybe not 10 years, maybe not 20 years, but 30 years, 40 years, 50 years, what you do is no longer relevant. That's the word. Every car in 20 years is going to be electric, 100%. Well, again, I'm making a bold statement there, but I believe we're going in that direction, and it's going to come faster than we think. So the need for energy, forget 20%, it's going to be all of them. The need for energy, nuclear. It's the cleanest, biggest source. Small nuclear reactors. There's a bill in Congress right now. They've passed it at some of the state levels. Indiana, Iowa. You're going to start to see it in the Midwest. We need energy. We need green energy, and we need it fast. Nuclear. So hydrogen. So the technology is getting better. We don't have to worry about it. But the problem with nuclear has always been, not in my backyard, Chernobyl, 3 Mile Island. And so, yes, we all need it, but just not near me, please. So that's, you know, the narrative and the story there. And so they've got to build the capacity. MTZ is a company in the US that I own. These guys are going to be big players in the infrastructure building. There's a couple of people that build, you know, wire towers, electricity. We've got to redo the whole grid to handle the new world. Electricity is going to have to get moved, get stored. There's not enough wind. They're going to have to do solar. So there's not enough sun. They're going to have to do wind. They're going to have to do battery backups. That's the future, folks. Right? So very interesting. Okay, what else do we got here? With the state of affairs, I did that one. If Putin takes over Ukraine, then in my view, the West needs to keep financial sanctions in place until he withdraws. So I think Putin will finally agree to sit down at the table once Zelensky's out of power and that he gets what he wants. The scenario that Putin is able to not take over Kyiv and kind of control the government and governing of Ukraine and leaves is only going to be viable if they cut off that piece and it officially becomes a Republic of Russia. And, you know, apparently that's a hard no. So it could persist for quite a while here. Russia's size of the global economy is in the magnitude of 3%. You add in Ukraine, you're talking 4%. It's not insignificant. As we talked about last week, the major issue to me is the food supply chain and what that means and how long that persists. Because if there's warring going on in the Black Sea, all those ports that would deliver the oil and wheat, are shut and they're under threat, and they can't get insurance for the boats, and nobody wants to come in to take the oil. No one wants to come out, and it just gets too expensive. And yeah, the Russian economy and the Ukrainian economy will be an utter collapse if it's not already. Food shortages, humanitarian disaster. Putin is a war criminal. There's no other way of looking at it. So yeah, it's a big issue there. I think China is coming on board. We heard a statement there today, very carefully crafted, their wording on what they're saying here. So China comes to the table. It's going to be able to negotiate, but I don't think Putin backs away until there's a coup or that he gets what he wants. And that's kind of my view on it. A lot of people have different views. Do I have an ETF that I like in taxable accounts that would be simple for young investors? Sean, great question. Horizon's ETFs have these total return swap ETFs where there's no annual distributions, and they're within a structure that's very, very tax efficient. And you should have a look at Horizon's ETFs. It's the only platform in Canada that, by way of ETFs, offers that tax benefit solution. So that might be something you want to have a look at. In the shorter term, is the Russian oil going to get to India and China? To my knowledge, Russia has only small pipeline system to China and cannot export a lot of oil. So that's my understanding too as well, James. It probably takes a couple of years before they can build new pipelines and get new supply channels going. But crude by rail could increase rather quickly. We saw that here in Canada. The oil is going to get sold, whether it's through a pipeline or through a more dangerous transmission through a train, in my mind. The oil is going to move. So one way or the other, I think the supply chains rebalance, and the West buys less and the East buys more. And at the margin, the West pumps a little more, and we kind of rebalance. So that's kind of my thought on that. Am I bringing the roadshow to Kelowna anytime soon? I love Kelowna. It's one of the pristine places in Canada. My wife's never been. She always wants to come with, but we're there for like 24 hours. She's now got one of her running friends there. So if we do go, and I don't know this, but if we do go to having live road shows again down the road, I love not having to wing around the country, I have to tell you. But probably some point down the road, we start doing live events again. You tell me, folks, when are you going to feel comfortable sitting in a packed elbow to elbow theater listening to Larry, if COVID is still a lingering thing, and variant, and I don't know the answer to that. I don't feel comfortable in an elbow to elbow packed event, and so no time soon am I going to start doing that. We'll see what 6 months brings and a year brings, and we'll see. And hopefully before I decide to retire from Bay Street. But I'm still in my mid 50s, although it's ticking up to the upper 50s, and I still got a good 5 to 10 year runway ahead of me before I look to slow down a little bit. But I think you can rest assured that I'm always going to be an advocate for education for investors. It really is a passion. Folks, we're out of time tonight. Thank you so much. Please consider sponsoring one of our charities. I'll be thrilled to match your investment. Great causes, they do great work. The links will be sent out along with the PDFs of this report tomorrow. And if we can track your donation, we can match it. Be safe, everyone. Go Leafs, go. Happy St. Pat's Day.